Good morning. Debt yield explained. The metric that lenders care about the most. And when commercial real estate investors talk about loans, the conversation usually starts with interest rates. But when lenders talk about loans, the conversation starts with risk. And the cleanest risk metric in commercial lending is debt yield. So if you're investing in multifamily or industrial, retail, medical office, land development, in Houston, Katy, or Fulshire, understanding debt yield isn't optional, it's foundational. So, what is debt yield? Well, debt yield is your net operating income divided by your loan amount. That's it, really simple. But what it does is it measures how much income a property produces relative to the lender's exposure without considering the interest rate or amortization on the loan. So, for example, say you have a property, it's bringing in 500,000 in net operating income, and you have the $5 million loan amount. Your debt yield there would be 10%. So this means that the property produces a 10% return on the lender's principal balance. So from a lending perspective, that's pretty clean, simple, and conservative. So let's talk about why lenders prefer debt yield over DSCR as a performance metric. And borrowers obsess over debt service coverage ratio. But DSCR can be influenced by the interest rate on the loan, the amortization period on the loan, as well as the loan structure. And what debt yield does is it removes those variables. And what it does is it answers one really simple core question. And if the lender had to foreclose tomorrow, how strong is the income relative to the principal balance on the loan? And that's why debt yield is used heavily by CMBS lenders, but also debt funds, particularly insurance companies as well, but also large regional banks and institutional capital providers. And what it is, it's a pure credit risk metric, and that's why it's useful. So let's look at how debt yield impacts your leverage. So this is where most investors misunderstand underwriting a little bit. And lenders will often have a minimum debt yield requirement. So, for instance, 8% is a strong institutional multifamily type project, whereas maybe a 9-10% is a retail or suburban office. And 10 to 12% would be more of a higher risk type asset. So, if your property is producing 500,000 in NOI and the lender requires a 10% debt yield, the maximum loan would just be the NOI divided by the debt yield, which is 500,000 divided by 10, which gives you the $5 million loan. And if your purchase price was 7 million in that instance, your leverage just dropped, regardless of what the LTV says. So debt yield frequently caps leverages before LTV or DSCR does, is the point. And why small NOI changes move loan terms? Well, here's where discipline matters. And if NOI drops from 500,000 to 450,000 at a 10% debt yield, 450 divided by 10% is a $4.5 million max loan. So you just lost 500,000 in leverage from a 10% income reduction. And what it does is that's going to impact the required equity to make the deal work, but also the investor returns you're going to have to pay, and your exit valuation when you sell the property, but also your cash on cash projections, because it's going to be a little bit more diluted. But small operating inefficiencies can materially impact capital structure is the point. And that's why professional lenders will scrutinize a number of things, particularly your T12 statement. They'll want to confirm accuracy of the rent roll and also look at the expenses and make sure they're normalized for current rates. And there could be one-time income adjustments as well, or vacancy assumptions that you have to build in. And the point is, capital markets don't underwrite optimism. They underwrite durability. So let's take a look at debt yield versus cap rate. And don't confuse the two. They're different. And both are percentage metrics, so that's same. But they serve different purposes. So cap rate is historically a measure of value, whereas debt yield is historically a measure of lender risk. So you can buy at a 6.5 cap rate and still fail debt yield requirements. And in today's tighter credit environment, especially across Houston's office and suburban retail segments, debt yield is often the binding constraint. So you may be asking yourself, why did this matter? I'm here in Katy, Fulshire, and West Houston. So in submarkets like those, industrial cores along I-10 or retail near FM 1093, or where there's a medical office growth in Cinco Ranch, or even value add plays, multifamily plays, debt yield is really going to determine how and whether or not you're able to get 75% leverage, or if you can only get, say, 65% leverage, or just don't get approved at all. Usually it's the middle of those two where you have to bring more cash in. But sophisticated investors prepare underwriting models around debt yield and not just rate shopping is the point. So let's look at capital markets insight here. Borrowers will focus on rate, but capital providers focus on a risk-adjusted exposure. So you have to balance the two. And understanding debt yield signals and what that speaks to the lenders, that it shows that you can speak their language. And that alone is going to improve your deal credibility, but also your negotiation strength and the term sheet quality you're able to obtain. But most importantly, your certainty of execution. And the point is, capital is going to flow towards disciplined sponsors. So learn something when you can. And here's the final thought on debt yield. And if you're underwriting based on what's the rate going to be, you're thinking like a borrower. If you're underwriting based on, well, what does the debt yield need to be to support this deal, you're thinking like a capital allocator. And that shift changes everything. And I'd love to talk to you more about your specific scenario. Please visit HoustonRealEstateBrokerage.com and you figure out how to get a hold of me. We can talk more. Take care.